Follow-up discussion on the Tesla earnings call, in particular the P&L. Is Tesla profitable enough? Could they be more profitable? People are questioning the profitability. I want to share our thoughts about this particular issue. This is a Not Even Wrong podcast. It's April 28, 2021. This is Krimdelko. Since the last update, we are down 4.7%. The market is roughly flat. For the year, we are up about 0.5%. The market's up 10.5%. We're underperforming by 10%. So Tesla announced earnings on Monday. Since then, the stock is down about 5%. And I think the main criticism about the Tesla earnings call from Wall Street has been the lack of profitability, or in other words, why isn't there more money after everything? Why isn't the bottom line higher? Now, let me go through the P&L and then we'll discuss our thoughts about this particular issue. Just to sort of anticipate this conversation, we believe Tesla is a growth company, and therefore what really matters is gross margin, and then the rest is kind of a wash. So you have operating leverage, you have profitability on the EBIT line and net income, but then everything gets back invested into growth. And if you're a growth company, particularly 50% growth company, then it is very difficult to generate GAAP net earnings. Tesla has been able to do that, but I think more importantly, Tesla has been able to generate free cash flow, and this is what matters. So what you really want from a growth company is industry-leading gross margins and free cash flow. If you can deliver that, I think you have everything in place to be a leader in the space, and also to generate a very high valuation. So let's talk about the P&L in particular. So Tesla had record sales in terms of deliveries, particularly on the automotive side, and they also had very good gross margins. Not the best gross margins ever, but good gross margins. They were 26% with credit and 22.5% ex environmental credits. So just to give a context, this is record high gross margin for any car company, but Tesla is not a car company. Tesla is a technology company, and therefore the gross margin is it's good, but it could be better. It's kind of hard to pin it down because we don't know, is Tesla a software company? Is Tesla a tech company? Is it a car company? Is it an energy company? Depending on what it is, the gross margin is either very high or very low. So I think, therefore, we just have to agree that this is a Tesla gross margin, and as long as it gets better, I think we should be happy, and it is getting better. Now, let me talk about the regulatory credits. Regulatory credits, from the Wall Street perspective, are considered as sort of icing on the cake, but nobody is taking them seriously, in a sense that nobody would say Tesla has delivered 26% gross margin, because the regulatory credits are pure 100% margin, and they are not there because Tesla has a certain type of business that allows them to generate these margins. They are there because of a regulatory environment that benefits Tesla. Now, my view on that is that, in fact, you should look at a company as a wholesome deliverer of cash flow. So, every company has situations where you could say, well, this is not really our business. Like, Starbucks could have a good quarter because some stores did well because there was a shortage of something, or very typical Wall Street firms like Goldman Sachs. They have almost every quarter, they have things, let's say good trading income, or they made money on a P&L, or they had a huge write-down, also on the negative side. So there's always something that you could say, well, this is not the core business. And I think really a company like Tesla, which is, in Elon Musk's words, an agglomeration of startups, almost by definition will have continuous sort of one-off items. And I think the healthiest way to look at Tesla is to say, look, this is the business. The same way that we are not excusing Tesla, for example, for having issues with chip shortage, or we are also not saying, well, because there's port congestion, well, this is a one-off and Tesla will do better in the future. We are just saying, look, this is the business. You will always have issues. You will have issues with port. You will have issues with chips. So how are you managing over time what is your gross margin? And therefore, I believe that the 26% gross margin actually is a number that one should take seriously. Now, let's go below the gross margin line. In particular, SG&A was relatively high. Now, there's stock-based compensation. Some of it is Elon Musk and things like that. I think the Elon Musk thing really is a one-off because it will, at least for now, go away soon. Now they might do another package and things, but I think if we put that aside for a second, plus that's not a cash item anyway, I think the main issue with the SG&A was higher R&D expenses and also expenses on the S&X line. I think the S&X line, that's easy to explain. There was, let's say, build out for infrastructure to be able to sell the S&X. And since there are no sales in S&X, of course, this is pure loss right now. And this is an investment which will pay off handsomely in the next quarter or two. So that's absolutely no concern. Now, the R&D, I think, is not even not a concern. It's actually a good thing. I mean, if you want Tesla to do one thing, Tesla is a $700 billion company. It has 50% stated growth goals. They need to invest in R&D. We've said that many times based on our principal stack that disruptors are companies that are able to iterate fast and have low cost of iteration and also are able to continuously drive down costs. There's no other way to do that than to invest and keep investing in knowledge, in explanatory knowledge, in instantiations of that knowledge into technology, i.e. in engineering, and Tesla is doing that, so we're very happy with that. This is reminiscent of Amazon when they used to have decent gross margins but never really had an operating profit, and people were saying they're not making money. Well, that was true. That's not true. Amazon was and is still building just a gigantic Golden Gate Bridge, or in other words, a massive infrastructure play that will just continuously generate humongous cash flows. And I think Tesla is a bit earlier, of course, than Amazon, but Tesla is exactly doing that. So I think when it comes to the P&L, we have to understand that, yes, Tesla is not necessarily profitable on the operating and net income line, particularly if you exclude regulatory credits. But there's two things to say here. Number one, you should not exclude regulatory credits because they are part of the business. And number two, even if you exclude them, as long as Tesla can keep growing at a decent industry-leading gross margin and generate free cash flow, you should not be worried at all, because all the company needs is cash and investment into growth initiatives, and that's exactly what Tesla is doing. Therefore, we are very happy with this quarter. We've discussed this in our previous episode about the earnings call. There are a few things that maybe came across a little bit negative. For example, the push out of the S and the X by, I think, another quarter, the lack of conversation about Cybertruck. These are things that concern us. We would like to see these cars coming to market faster, but we also acknowledge that the demand for Model 3 and Y is such that we just see a potential for Tesla to generate very high volumes, and also which is going against their mission, of course, going with their mission, which is to replace fossil fuel cars as fast as possible. So why not push where the demand is, where the volumes are, where people are comfortable with. Also, the 3 and the Y are really not mass vehicles in a sense, like cheap and like Honda or Toyota or something, but not far away. And I think that is definitely important. But let's not understate the importance of the S and X, because they are important for the brand image and also important for the margin. So to summarize, we have a very good picture of Tesla in terms of being a growth company, generating record-leading gross margins and cash flow, which is what we care about most as investors. We're happy with their massive investments in R&D, because we believe that this is really what we're investing in. We're investing in R&D as far as electric cars, intelligent cars, and decarbonizing energy infrastructure is concerned. We think the negatives of the call were not, let's say, the lack of operating profit. We are not concerned about that. What we're concerned about is the delay of S and X. We're a little bit concerned about lack of more concrete positive news in the 4680 battery line, because this is an absolutely key aspect of the Tesla business. We're not saying it's negative what they said, but let's say I would have liked to see a bit more, maybe a more elaboration by Drew Ballino about where they stand and when we should expect the first cells. I think the lack of conversation about Cybertruck also alludes that probably They are a little bit delayed maybe in terms of delivering this new battery architecture, because you need the new battery architecture to actually deliver the Cybertruck. So this is probably the reason why a sell-off of 5% is warranted. But again, I mean, these are of course maybe 1-2 quarter issues, maximum 2, probably even less than 2. So of course they will be solved, and we expect therefore the stock to continuously do well. Thank you.